Net zero adoption has reached a tipping point, but how do we ensure decarbonisation is done right? We expect 2022 to be characterised by a shift from net zero adoption to net zero scrutiny. For both corporates and investors, the easiest way to decarbonise a portfolio is often to sell assets, but these transactions don't always result in real-world emissions reductions. Sometimes we simply move the emissions around. The solution to this is greater disclosure and transparency. For corporates, this means demonstrating how the buyer of an asset has an equally ambitious emissions reduction plan. For investors, it means demonstrating how portfolio emissions are split between organic decarbonisation and changes in the portfolio.
Consumer staples underperformed the market last year, and especially the household and personal care sector had a rough time. I think this subsector in particular is set to have a strong comeback. Price increases that were implemented in the second half of last year are now coming through, and they're starting to become visible in company reports and in this upcoming earnings season. Meanwhile, cost inflation is starting to ease, and we're seeing some of the most important commodities like plastic starting to come off recent highs. Now, this is a subsector that has very low price volume elasticity, and consumers are not reducing purchasing of laundry detergents or skincare products. So this incremental pricing is actually a net benefit to sales growth for these companies. And it's also showing that these companies actually have pricing power. And this is contrary to consensus, which is not modeling that incremental sales growth, and it's also not expecting a full margin recovery. So if you couple that with low valuation levels, this is really creating attractive investment opportunities.
We have 3 predictions for stewardship. First, net zero. We think there'll be an increased focus on the just transition. The UN Framework Convention on Climate Change identifies 1.5 billion jobs that are critical to climate stability. So we think investors will focus much more on how companies are engaging with workers and communities across their transition plans. Secondly, we think the focus is shifting from board level to executive level diversity. The UK's Hampton-Alexander review reports on significant progress on board diversity, but still quite slow change across executive teams. Finally, we think the level of support for executive compensation plans will continue to decline. In the US, 2021 saw the lowest level of support for executive compensation since say-on-pay proposals were introduced.
There's been a steep recent sell-off in high-growth tech stocks, with many now 30 to 50% below their peak levels. I think investors right now are struggling to really identify a floor in some of these stocks. And my prediction for 2022 is that you could see private equity start to step in and pick off some of these secular growth companies that are trading at a discount. If that happens to a few high-profile companies, it could mark the bottom and a rebound of public market investor demand for tech companies with these attractive long-term growth profiles.
In 2022, we think fintechs could struggle to monetize in a number of areas, particularly in the payment space and where they're trying to challenge traditional banks. Here, they are largely restricted to consumer lending with little or no access to mortgages and corporate loans. Growing regulatory risk is also a concern, as is the quality of debt they have in their books. Fintechs are likely to perform better though in the very small niche markets such as SME, where their value proposition cannot be as easily replicated or challenged by incumbents. We believe the market will slowly understand these dynamics, and together with rising and higher rates environment, we think the market will find it difficult to give very high valuation that we saw in 2021 to these fintech companies.
2021 was an extreme year in terms of physical climate impacts on different sectors and geographies. For example, freeze event in Texas triggered mass blackouts, causing shutdown of one of the largest chemical complex. This resulted in the shortage of resin, which is a key raw material in the global supply chain. In 2022, we expect these climate impact trends to continue and evolve our physical climate risk framework to monitor such risks.
Climate and sustainability issues are increasingly impacting the long-term financial performance of companies, and we're seeking to understand how technological disruption, particularly from energy transition and climate change, changing consumer preferences for more sustainable products, and also the more ambitious policy agenda set by governments following COP26 last year in Glasgow will impact those companies and their long-term financial productivity.